All right, thank you for your patience as we switch gears to talk about property, plant, and equipment. These are also known as fixed assets. And so we're going to talk about the accounting process for fixed assets. We're also going to jump into a concept called depreciation. Depreciation is a very difficult concept, so I'm going to do my absolute best to explain it in a meaningful way. I know that we talked very briefly about this recently, but we're going to jump a little deeper this time. And we're going to talk about different methods of depreciation. So, when we get to that point, feel free to ask a lot of questions because I know it's a difficult concept for most people to understand. We're going to talk about fixed assets, how to depreciate them, how to account for changes in property, plant, and equipment, all that good stuff. So, plant assets, called property, plant, and equipment. These are tangible. You can physically touch them. They're used in the day-to-day operations of the business in order to help the company to generate revenue. We call that expected future benefit. Yeah, that's the expected future revenue. Okay, future benefit, future revenue. Expected future benefit means that's the revenue we expect to earn from the use of the property, plant, and equipment. Because the whole idea behind an asset, as you know, is to help us to generate revenue. We use cash, we use inventory, we use property, plant, and equipment to help the company to generate revenue. We use our assets to help to generate revenue. Our fixed assets, property, plant, and equipment, help us to generate revenue. That's the whole idea behind this. Now, with property, plant, and equipment, they go down in value over time. The reason why buildings, equipment, vehicles, other fixed assets, the reason why they go down in value over time is because they lose their usefulness. Okay, for example, let's say you own a car. Your car goes down in value over time. That's normal. It's supposed to. The reason is because as you drive the car, it's developing wear and tear. It requires more maintenance. It's gaining a lot of miles. It uses usefulness. It's less useful over time, you see? That's why we say that assets depreciate over time. They lose their usefulness. So, what we do in this process in accounting is first thing we do is figure out what is the cost of purchasing, acquiring fixed asset. And this acquisition cost includes things like the purchase price, the cost of installation, the cost of insurance, the cost of startup fees, whatever. All of these costs together equal the total cost of acquisition, the original cost. The second thing we need to figure out is how long is this thing supposed to last for? In other words, how many years can I get out of this asset as it loses its usefulness until the point where it reaches the end of its useful life? We call this time period useful life. How long can I use it for? Until it reaches a value of 0. Basically, that's step 2. Step 3 is account for any subsequent expenditures. Meaning, if I need to make an extraordinary repair, like replacing a transmission in a car, real big expensive part, what that repair does is it extends its useful life. Right? So then I have to recalculate the depreciation. That's step 3. And step 4 is recording of the disposal of the asset. The vehicle or the asset at the end of its useful life, sometimes it's worth something. We call that scrap value, also known as salvage value. So those are the 4 things we calculate when we look at depreciation of a fixed asset. And so I'll walk through this with you. So, the acquisition. The acquisition cost of a fixed asset includes things like the purchase price, the cost of installation, the insurance, testing, assembly. We add all of those costs together in order to get the asset into service, meaning in order to get it up and running. All of those costs together equal the total acquisition cost. Yeah. For machinery and equipment, it includes things like, this is the acquisition cost, it includes things like the purchase price, installation, assembly, testing, the taxes on the purchase, the transportation charges to ship it from one place to another, the insurance while it's in transit, etc. Put all these together to get the total acquisition cost for machinery and equipment. For buildings, physical building works a similar way. It's the purchase price, or if you're building it, construction costs, brokerage fees, title fees, attorney's fees, taxes, any other land improvements or repairs, renovations. All of those things are added to the total acquisition cost for a building. And of course, land improvements. Land improvements include things like parking lots, driveways, fences, walkways, lighting systems, things that make the building look nice. Yeah, land improvements. We add those to the total acquisition cost. For land, property, and equipment, this is the property part. For property, it's the purchase price of the physical land, any real estate commissions, legal fees, surveying fees, property taxes, insurance, etc. All those equal the total acquisition cost for land. It's important to know this very important difference. Land does not depreciate. The building the land sits on does. Here's what I mean by this. Land, being the physical dirt the building is sitting on, that doesn't depreciate. The reason for that is because land is infinite. Land will be there forever. I can knock the building down, put another one over it. Knock that building down, put another one over it. The land is still there. The land ain't going nowhere. The dirt's still there. I can keep building to my heart content. Because of that, land does not depreciate. The building the land is on does. Sometimes when you purchase a fixed asset, it might be what we call a lump sum purchase. Okay. With a lump sum purchase, you might be purchasing multiple assets at once. Here's what I mean by this, and this is a great example of this. The total cost of combined purchases include things like land and the building. It's based off of the market value. Yeah, how much would it sell for in the open marketplace? So here's an example. CarMax paid $90,000 cash to acquire a group of items consisting of land at $40,000 and a building at $60,000. The $90,000 cost is allocated based off of the appraised values below. Appraisals work like this. An appraiser, someone who understands market values, comes in and places a value on the land and the buildings. Yeah, helps you to understand what it would be in the open market. That's how appraisals work. So we have the breakdown. Building, 60,000. Land, 40,000. To put it simply, the portion cost is 90,000. On the 90,000, 60% of it goes to the building, 40% of it goes to the land. Okay. The appraised value came in at 100,000. We bought it for 90. That's a good deal. Okay. So, because the appraised value is at 100,000, 60% to building, 40% to land. So 60,000 goes to the building, 40,000 goes to the land. Yeah. Basically assigns the value for the lump sum purchase. And of course, we make our journal entry when we make the purchase. Debit building, 54,000. Debit land, 36,000. Credit cash, 90,000. Okay, depreciation. This is, again, probably the most important and also confusing parts of this chapter, and I want to make sure that you all really understand how depreciation works. I want you to leave today's lesson feeling confused. Okay. So I'm going to talk to you about 3 different methods. There's more than 3, but the 3 most commonly used methods for depreciating fixed assets: straight line, units of production, and double declining balance. Straight line is the easiest, so I'll walk through a couple examples with you. First, what is depreciation? It's the recognition of the loss of usefulness of the asset over time. It's a simple definition. That's Dr. B's definition. Okay. Depreciation is a process of allocating the cost of the plant asset to expense the accounting periods that benefit from its use. That's your textbook saying that. Dr. B says depreciation is recognizing the loss of the usefulness of the asset over time. We're depreciating it in value. Very simple. Okay. On the balance sheet, under assets, as you know, we have current assets and fixed assets, also known as long-term. Under current assets, we have cash, accounts receivable, inventory, etc. Current, within 1 year. Long-term or fixed, we have property, plant, and equipment. Buildings, equipment, vehicles, etc. Those are all fixed assets. Sorry. They're on our balance sheet, and we record those at the acquisition cost. Over time, we record the depreciation at the end of each year. We debit depreciation expense and we credit accumulated depreciation. Accumulated depreciation is an account on the balance sheet, which is what we call a contra asset account, meaning it holds a credit balance and it contradicts the fixed asset. That's how we recognize the depreciation. I'll explain all this to you here in a second. Just want to have you have a quick understanding of it. So let's talk about the depreciation. We briefly mentioned this earlier. The acquisition cost, we need to know what that is first. The salvage value, also known as the scrap value, that tells us how much the asset is worth at the end of its useful life. If I were to scrap this asset, what's it worth? If I were to salvage this asset, what's it worth? Right? Bring it to the salvage yard or the scrap yard. How much are you going to give me for it? That's salvage value. And the third thing we need to know is useful life. How long is this asset supposed to last? Useful life. Yep, that's what that is. So those are the three things we need to know in order to calculate the depreciation. As I had mentioned, there are three primary methods of calculating depreciation. The first is called the straight line method. That's where we depreciate the value of the asset the same amount every year over the useful life. It's straight line. That's why I would call it straight line. It's the same amount every year. The second method is called units of production. This is where we depreciate the asset based off of the number of units being produced by the asset, meaning number of products that the manufacturer is producing using those assets. You see? So that one's a little bit more complex. And then the third one is called declining balance, also known as double declining balance. Okay, and basically that's just a doubling of the straight line method. So I'll show you what all these three look like in action. So here we have some information for our example. Let's say, I don't know, this is a piece of machinery. Okay, what is this piece of machinery here? I have no idea. This is a piece of machinery. Oh, it's a shoe. It's to make shoes. Okay, that's cool. Piece of machinery. It's used to make shoes, athletic shoes. Here's the information we have for it. The piece of machinery cost us $10,000. It has a salvage value of $1,000. So that means at the end of its useful life, I can scrap it for $1,000. That means I can depreciate a total of $9,000. Okay, so that's good information to know. Its useful life is 5 years. I can use this piece of machinery for 5 years, and that's when it'll end its usefulness. Or up to 36,000 shoes. It's a shoe machine, okay? So this information is important because we're going to use that in the next to understand these three examples. Okay, so let's take a look at the straight line method first. Using the straight line method, we use the same amount of depreciation every year over the 5 years, the useful life. The formula for the straight line depreciation method is the acquisition cost in this example 10,000, minus the salvage value, in this case 1,000. So that gives us a total of $9,000 of depreciable cost. So 9,000 divided by 5 years. That gives us $1,800 per year for 5 years. So at the end of each year, I make an adjusting entry. Technically, it's a closing entry, but you see my point. We debit depreciation expense, $1,800. That's an expense account on the income statement. And we credit accumulated depreciation machinery. This is a contra flow account on the balance sheet. It has a credit balance on the balance sheet. It's an asset. Okay? It contradicts, contraflows, the asset. You see, in this case, machinery. It's a way of us being able to depreciate without directly subtracting it from costs we recorded on the balance sheet. Okay. So on the balance sheet, every year for 5 years, we reduce the value of the machinery $1,800. You see, straight line. Yeah, that's why we call it that. On the right side, we see the balance decreasing every year by that $1,800. Started at $10,000, that was our cost, and at 21, it's worth $8,200, and at 22, $6,400, so forth and so on. It goes down by $1,800 every year until it reaches the end of its useful life in 2025. Here you see a balance of $1,000. Why is that? Because the $1,000 is the salvage value. So on the balance sheet, we record the cost at $10,000. We have accumulated depreciation, the contra account on the balance sheet. It accumulates every year, yeah, until it reaches the $9,000 at the end of year 5. Yeah, that's what this shows. And to show you what it looks like on the chart, all the way to the end of its useful life, the depreciable cost is $9,000, depreciation rate's 20%. How did we know it's 20%, Dr. B? You didn't tell me about this percentage part, the rate. How did you know about this rate? Simply put, we take the $10,000. It's 5 years. 5, 10, 15, 20. So, it's how we find the percentage. So, depreciation expense is $1,800 each year. We draw it down to 9,000 because 10,000 minus 1 salvage value equals 9,000. See? And so this is what it looks like every year. We depreciate it by the same amount, 1,800. That's straight line. See? Any questions on straight line depreciation before we jump into units of production? We're okay? Straight line depreciation, any questions? Going once, going twice, we're good? Okay, I trust y'all. Now, that's straight line depreciation. Let's talk about units of production. Units of production helps us to depreciate the asset based on the number of units it has the potential to produce each year. That's a simple way of saying. That's based off of It's usage. How often I use the machine in the process of depreciating. Yeah, you see? So we do this in a few steps. Okay, just the 2 steps. Step 1, we have to find the depreciation per unit. How do we do that? We take the cost, the total cost of the machine, minus the salvage value, divided by the total units of production. It gives us depreciation per unit. In our example, cost is 10,000 minus salvage value 1,000. That's total depreciable cost of 9,000. Total units of production, we said were 36,000 units. Gives us a depreciation per unit of 25 cents per unit. 9,000 divided by 36,000 units. Depreciation per unit of 25 cents. Okay, step 2. We find depreciation expense. How do we do that? We take depreciation per unit. For example, 25 cents. Times the number of units produced during the period. Number of units produced during the period is based off of the number of units that we were able to make during the year. Yep. That part we don't know. We have to find out. So let's find out. So here we have the information. We were able to produce 7,000 units during the first year. Great. So, step 1 we've already done. Cost minus salvage value divided by number of units of production. 9,000 divided by 36,000 is 25 cents per unit. Step 2, 25 cents per unit times 7,000 units that we're able to make in the first year. So my total depreciation expense for year 1 is 1,750. Okay. Now we know that in manufacturing, we don't always make the same number of units every year. It just doesn't work that way. Some years you'll make more, some years you'll make less. So we use some information from what we call a production schedule. The production schedule is an estimate of the number of units that we expect to produce each year. And so we apply the units of production depreciation to this schedule. We know that it's 25 cents per unit. We have an idea of how many number of units we'll produce in each year. So number of units times depreciation per unit equals the depreciation expense for that year. By the time we reach year 5, which is the end of its useful life, we would have produced 36,000 units. Okay? And our depreciation expense should be $9,000. Why? Because we have a salvage value of 1,000. Any questions on the units of production for depreciation? This is probably the most complex one, in my opinion. Good? Did I do an okay job of explaining that? I'm not on mute, right? You guys are still here? Okay.
We're here.
All right. I get nervous sometimes. I saw Michelle give me the thumbs up, so that's a good thing. You know, I just want to make sure that y'all still here, and it's clear, right? It makes sense. Okay.
Yes, sir.
All right. I promise that's probably one of the most confusing ones for depreciation. All right, good. I'm glad you all feel that that's good. On to the next. Double declining balance method. This one's, in my opinion, pretty easy. Here's how it works. We use the straight line method, and we factor it by 2. Simple, right? Here's how it works. There's 3 steps. The first step is we find the straight line rate, the 20%, remember? So how is it 20%, you ask? We take 100% and divide by its useful life. So 100 divided by useful life, in this case 5. Percent divided by 5 is 20%. That's how we found the 20% from earlier. So 20% useful life, straight line rate. Step 2, we find the double declining balance rate. This is very easy. Step 2. We take 2 times straight line rate. 2 times 20% is 40%. Okay? Step 3. Step 3 is a little bit more complex. Step 3, we have to find depreciation expense. We do that by taking the double declining balance rate, in this case 40% from step 2, times the beginning book value, 10,000. 40% times 10,000 equals $4,000. The $4,000 depreciation expense is for the first year. Well, Dr. B, what about the remaining 5 years? You're asking. Here's how it works. Take book value times depreciation rate, 40%, equals depreciation expense. For the first year, it's 4,000. Value of 10 times the 40 equals 4,000. Okay? Now that we know that, we take 10,000 minus depreciation expense to get the beginning book value for the next year. In this case, 6,000. You see? We take that new amount, 6,000, times the 40% to get the depreciation expense for year 2. In this case, 2,400. But we're not done. 6,000 minus the 2,400 equals year 3 beginning book value of 3,600. Times 40% is 1,440. 3,600 minus 1,440, beginning book value of year 4, 2,160. Times 40%, 864. 2,160 minus 864, beginning book value, 1,296. 1,296 times 40% is 296. And you'll see we ended year 5 with a $1,000 book value. That's the salvage value. Yeah. So it all ties together. That's the double declining rate method. Questions on the double declining rate method? Or did all that make sense as well? Good? Right. Just making sure. Right. I'm just making sure. This is probably the most complicated part of the chapter. So I just want to make sure that you all understood the concept. Okay. I trust you.
Don't worry, Professor. I got you subscribed. So
I like that. All right. So let's take a look at all 3 methods, right, side by side. So let's take a look here. The first one was a straight line method. Every year we depreciated $1,800 for our $10,000 asset, right? For units of production, it was based off of the number of units being produced in each year. So it's kind of a little all over the place. It's based off of the number of units we expect to produce in each year until we get to the 9,000. And then double declining balance. We see that it declines by double, right? It's the whole idea. Until it reaches where it's supposed to be. So you might ask, What are the popular ones? So straight line's the most popular. That's because it's the easiest. Seriously, I mean, you know, uh, small business owners don't have that kind of time. Don't have the type of education from Dr. B to be able to calculate these other methods. They use straight line. 5% of companies use straight line method. And then the other ones, production 5%, double declining 6%, and then other ones 4%. It gets a little crazier, believe me. But these three are the most common. All right. So where does useful life come from? Sometimes people ask me, Dr. B, how do you know it's 5 years? I bought this tractor, and the manufacturer tells me it should last forever. You're telling me 5 years. Where'd you come up with 5 years? IRS. The IRS publishes a report every year. It's called the Maker's Report. The Maker's Report is known as the Modified Accelerated Cost Recovery System. Only the IRS would think of a name like that. Modified Accelerated Cost Recovery System, published by the IRS every year. And it tells you, as accountants, those business owners, what useful life is for most things, how long it should last. It tells us, sometimes graphically, sometimes. It gives you an idea of how long it should last. So we use that report to tell us how long. So sometimes things happen mid-year. You might purchase the equipment in the middle of the year. You might sell it. Something happens to it. So we make modifications to the depreciation. For straight line method, let's say we had that awesome piece of machinery for 10,000, has salvage value of 1,000, total depreciable cost 9,000, supposed to last 5 years or 36,000 units. Let's say we bought that in October. Okay, well that's only 3 months. So we got to allocate 3 months worth of depreciation. How do you do it by month? Take the cost minus the salvage value to get the total depreciable cost divided by the 5 years useful life times 3/12. 3 months out of the year, right? To get $450. That's if we bought it and put it into service on October 1. You can figure it out by month, Sometimes things happen to the machinery and we change its useful life or we change its salvage value based off of changes to the machinery. Yeah. Example, I gave the example of the car earlier, right? So the car transmission goes out, you replace the transmission, all of a sudden you've extended the useful life of the car. Same thing with machinery. Transmission goes out or it needs some engine overhaul or some type of very serious mechanical expense. So we make the modification, it extends the useful life. Or the salvage value changes, like all of a sudden the price per pound of metal goes up, whatever, changes the salvage value. All these have effects on the depreciation estimate. Here's an example of that. I had a piece of machinery, value $10,000 was the cost minus the accumulated depreciation, $3,600. During year 4, something happened to it. Yeah. So we revised the useful life downward by a year. So we had to revise everything else. So the book value is 6,400 at the time, minus $400 revised salvage value, divided by the revised useful life of 4 years. So that gives us a revised depreciation per year of 1,500. Yeah, these things happen. So that's depreciation. Any questions at all on depreciation? But okay. Great. All right.
Yeah, Professor.
Awesome. Awesome. Thank you. So it's important to understand the difference between revenue and capital expenditure. You might think that this sounds obvious. Revenue is when we make money from selling stuff. Yeah, that's exactly right. Capital expenditure is when we purchase property, plant, and equipment. Let's talk about these things. Revenue is when we generate revenue from sales from our customers, right? We use that revenue to pay for the day-to-day operations of the business. So based off of the money coming in from our customers, we use that money to operate the business. We call that revenue expenditures. We use it for paying our employees, paying our monthly bills, etc. And report it on the income statement, as you know. Capital expenditures is from money that we set aside in the little savings account. Or the owner was nice enough to make contributions to the business. And so those funds used on the side, we use those to purchase fixed assets like property, plant, and equipment. Okay? Call those capital expenditures. Oh, yes, repairs. So earlier I gave an example where we replaced transmission, a piece of machinery. That's a big deal. We call that an extraordinary repair. Not just because of the high cost of putting a new transmission in, it also extended the useful life of the machinery. When something extends the useful life of the machinery or is kind of like an overhaul, we call that an extraordinary repair or a betterment. We improved it.
Does that increase the value?
It can. It sure can. It depends. It might increase its salvage value. Probably. Yeah. It sure can. So that's extraordinary repair. Then we have ordinary repairs. I call this general maintenance and expense, right? Repairs and maintenance. This is things like we changed the oil, we put new tires on, we changed the battery. You're going to do this stuff anyway, okay? To keep it running, all right? When you just make repairs to keep something running, it's called ordinary. You're going to do it anyway. It's to prevent wear and tear. Yeah, those are ordinary repairs. Yeah, so that's the difference between those two. A couple of examples of journal entries that we would make for those. An ordinary repair, we just debit repairs expense, credit cash. But if we are improving an asset by putting a new transmission in or automating it or whatever we're doing to it to improve it, to extend the useful life, we debit the asset account. To Leland's point, we increase the value of it. Because that's technically what we're doing. We're extending its useful life. So we debit the asset account and we credit cash. Okay. At the end of the useful life, sometimes before the useful life, we might dispose of an asset, plant asset. It happens for various reasons. Either it broke down, we can't fix it, or our business model is changing, or I want to upgrade my machinery before it breaks down, so we'll sell it. Disposing of it, we're selling it, we're getting rid of it. Okay. So when that happens, we obviously need to record the disposal of the asset. We update the depreciation schedule by recording journal entries. The journal entries would be something like, if we're receiving cash, we debit, and then we would credit if we're paying cash for whatever reason. If we're recording a gain on the asset, meaning I'm selling it for more than what I bought it for, it happens sometimes, right? We record that as a gain. So that would be credit to the asset account. If it's a loss, we debit it. To remove the asset off the books, it's a credit. To remove the accumulated depreciation, it's a debit. I'm not going to dive too deep into it, but I will give you a couple of examples here in a second. If the cash that we're receiving is greater than its book value, it's a gain. If the cash we are receiving is less than its book value, it's a loss. If it's equal to it, there's no gain or loss. The examples. I always like the examples because they paint a clear picture. We have machinery for $9,000, accumulated depreciation of $9,000. In other words, it's reached the end of its useful life. Okay? At the end of the fifth year. We decided that the equipment is using straight line depreciation over 8 years. It has a salvage value of 0. So we debit accumulated depreciation and credit machinery. It's fully depreciated. It's reached the end of its useful life. So all we're going to do is we're going to take it off the book. And to do that, we debit accumulated depreciation and credit machinery. We're taking it off of our book, off of our account, our asset account. This is not worth anything. I could still use it. Now let me clarify. Some students ask me, well, Dr. B, just because it reached the end of its useful life, you can still use it. It ain't broken. You can, yeah, absolutely. You just won't depreciate it anymore because you can't. You would just expense things out after the fact. Okay, here we have another example. Equipment with $8,000, accumulated depreciation of $6,000. So in other words, it has not yet reached the end of its useful life. We're using straight line for 8 years. So we decide to get rid of it. It's not yet fully depreciated. We're going to trade it in for a newer model, we'll say. Okay. First step, we record the depreciation up until the point where we decide to sell it. So debit depreciation expense 500, credit accumulated depreciation 500. This helps to get it to its current depreciation amount. Then we record the sale or the loss. We debit accumulated depreciation equipment, book value 6,500. Debit loss on the sale of the disposal of the equipment 1,500. Credit equipment 8,000. This helps to remove it from your books because it don't work no more. We're throwing it out, or whatever. We sell it. Oh, I love selling it. Okay, let's sell it. We're going to sell it. We're selling it at its book value. Wow, that's great. Okay. So we're selling the equipment. It cost $16,000 originally. It depreciated by $12,000, so we've had it in service for quite some time. Use the straight line depreciation, $4,000 per year. So that tells us it's 4 years, right? The equipment is sold for $3,000. Great. Sold it for what it's worth, basically. So here's how it works. We debit depreciation expense, 1,000. Credit accumulated depreciation, 1,000. That gets us up to its current time for taking off the books. Step 2, we record the sale. Debit cash, 3,000. That's what we sold it for. We debit accumulated depreciation of $13,000, and we credit equipment, $16,000. It's not a gain or a loss. We sold it at book value. What if we sell it for more than it's worth? Now we're talking. Right? It cost us 16, depreciated 12. Use straight line depreciation. We sold it for 7,000. Sweet. Okay, here's how it works. Update the depreciation just like before. And then we record the sale at a gain. Debit cash, $7,000, because that's what we received. We debit accumulated depreciation, 13,000. We credit gain on disposal of equipment, 4,000. We credit equipment, 16. But what happens if we, sell it for less than what it's worth? Sometimes you just got to get rid of it, you know what I mean? So we sell it less than what it's worth. Here's how that works. Debit cash for the amount we received, 2,500. Debit the loss on disposal of the equipment, in this case, $500. Say, not terrible, I guess. Debit accumulated depreciation, 13,000. Credit equipment, 16. So that's disposal of an asset. Now we got to talk about natural resources. In business, sometimes we use natural resources. Sometimes that is your business. This would include things like mining or drilling for wells, mining for gold, etc., drilling for oil, etc. Sometimes that is the business that the businesses are in. So how do we account for what these companies are taking out of the earth? We go through what's called a natural resources accounting process. Where we track the total cost charged to the depletion of the natural resource. Depletion is the process of taking natural resources out of the ground and using them. As you take resources out of the ground, like oil, coal, and gold, they're not renewable, so they're not going to show back up again in the ground. Once you use it, it's gone. It's called depleting it as you're using it. So the companies charge the cost of depletion. They extract the natural resources and report it at cost less accumulated depletion on the books. So here's what it looks like. a mineral deposit. The company mines for minerals. There's an estimated 250,000 tons of ore, raw ore. Purchased it for 500,000 with zero salvage value. The depletion charge is $2 per ton. If we mine 85,000 tons, the depletion charge is 170,000. 85 times 2. So here's the recording cost. Here's how the record looks. To find depletion per unit, we take the cost minus the salvage value, divided by units of production. In this case, units of capacity. Yeah. To find the $2 per ton. $500,000 purchase price minus zero salvage value, divided by 250,000 tons possible. $2 per ton. So we take that depletion per unit, cost per unit, times the number of units we extracted from the ground. 2 times the 85,000 is 170,000. Yeah. We make the journal entry at the end of the year, debit depletion expense, credit accumulated depletion. Very similar, isn't it? Very similar process. Depletion expense, sometimes you won't mind the whole thing, so you make adjusting entries. When it comes to depleting assets or depleting natural resources, we're using company assets to do that with machinery, usually heavy machinery. So those machineries will have their own depreciation rates, and we'll use units of production in order to depreciate those assets. What about something that's intangible? The word intangible means you cannot physically touch it. That's what intangible means. An intangible asset include things like patents, copyright, intellectual property, digital assets, things like that. So non-physical assets used in the operation of the business. They have a limited or infinite life depending on what it is. Provide. Go ahead, Leland. Okay.
I was just asking, the stocks count as
Stock?
intangible or tangible? Is that tangible?
No, not if it's not used in the day-to-day operation of the business. Like if you're in business to buy and sell stock, then yes. But if you're in business to sell like physical products, then no.
Mm-hmm.
Yeah, good question. For intangible assets, we record the cost when it's purchased at the purchase price. Okay, so sometimes you may not know that you can purchase a patent. Go down to the U.S. Patent Office, and they might have patents for sale. You're like, oh, that's cool. I could buy this patent. The purchase price would be cost plus legal fees, filing fees, and whatever other fees. Those are total cost. Again, includes things like patents, copyrights, franchises and licenses, trademarks, trade names, goodwill, right of use assets, also known as a lease, leasehold improvements, other intangibles, research and development, etc. Intellectual property, digital assets. Yep. There's one on here I want you to kind of know, called goodwill. Goodwill is where a company purchases the rights and other intangible assets of another company. That's called goodwill. Okay, we'll talk more about this in the future. I just want to let you know what it is because sometimes that question comes in. So yeah, we will talk about this here in a second. Uh, Patent, how long you can use something for, based off of its design. Patents usually last about 20 years. Copyrights, they could last up to 70 years, depending on what it is. Franchise and license fees could go year to year, depending on what it is. Goodwill is the amount of a company's value exceeds the value of individual assets and liabilities. Fancy way of saying one company purchases another company for the ability to use their intangible assets greater than its face value. Rights of use, this includes things like leases. Leasehold improvements, that's where you improve a leased property that you have. And other intangibles, digital assets. Research and development are based off of expenditures to discover, invent new processes, procedures, knowledge, etc. And of course, it wouldn't be an accounting class without at least a couple of ratios. So I want to talk about one called the total asset turnover. And what this one does is it provides information about the company's ability to effectively use its assets in order to generate a profit. And so we take the total net sales divided by average total assets. Again, there's that word average. Average total assets would take beginning balance total assets plus ending balance total assets divided by 2. That's how you find the average. And then, of course, a couple of random things that I wanted to talk about. Exchanges. In transactions, it's not always straightforward. You could buy and sell, sure. But what about an exchange? Oh, hey, I'll give you this piece of machinery for a piece of land. That's weird, but it happens. So, an exchange for property, plant, and equipment is totally possible, and it does happen from time to time. And so, I wanted to show you this example because while it's rare, sure, it is a possibility. So, the value of each asset needs to be determined in order to understand the gain or the loss in comparison to the market value based off the exchange. So that's where this concept comes into play. We're not going to dive terribly deep into it, but I just wanted you to understand how exchanges work. It's a similar concept to gain or a loss on the sale of a fixed asset. It's the same way, but just kind of different. Okay, that, my friends, is the end of our discussion today on property, plant, and equipment. Any questions on property, plant, and equipment? Anything at all? We did okay? Yeah? All right. Cool. I love it. Thank you for the thumbs up. All right. So, just to remind you about what's going on this week, what's due on Sunday, a couple of things as always. Under Engage and Explore, we have a nice week, nice and easy week, I think. I hope. We have our plant assets video annotation. Hopefully it works. It works, yes. So, and I see that some of you are in here already. Thank you, Leland. Yeah, go ahead and have fun with your annotations as you always do. So that's what you got for this week, and then of course you have your quizzes, one for chapter 9, one for chapter 10. Remember there's the two possibilities, etc. So, and of course because we had class today and we were able to get through both of the chapters, that means for this Thursday, I want you to focus on completing the hypothesis and also chapters 9 and 10 quiz. So that way it helps your life schedule. That's the whole idea. Any comments, questions, or concerns? No, good. Okay. Thank you all so much for your time today. I sincerely appreciate all of you. If you ever need anything, you can email me, call me, set up office hours. I'm always here for your success. Thank you so much for your time tonight. Appreciate you. Have a wonderful rest of your night. Thank you so much.
All
Take
right,
care.
Professor. Have a good. See you next Tuesday.